Good morning, everybody, and welcome to our webinar today, Exit Strategies, 11 Worst Mistakes. Thank you all for joining us. My name's Kevin Uphill. For those of you who don't know me, I'm the chairman of Avondale Corporate, and I'll be running this morning's webinar. We've got about an hour. The first half hour I'm going to be running really where I will talk you through some of the concepts. We're going to go fairly big picture because I think we've got some advisors in the webinar, and you'll know that often it's technicalities that can trip deals up, and we certainly don't have time to cover all of those. So we just want to go on the broad aspects. I'll be joined today after that first 25 minutes, half an hour, by my colleague Sally Hardman. She's one of our lead deal makers, and between us, myself and Sally, we've got over 50 years M&A experience, which is actually quite scary. I didn't enjoy totaling that up, but hopefully we've learned a thing or two as we've gone along about what not to do and therefore what to do in the process in M&A. So as I say, I'm going to be sharing some of our experience and then Sally will join in later in conversations. We would always take question when we get to the conversation area. So really want you guys to listen in and start using the Q&A panel as we go so that we can build up questions for that second session for the half an hour. We will be recording the session, so if it's good or you like aspects or you want to remember it, no need to take notes. You should have a recording which will circulate around. So 11 exit strategy mistakes. Number one, no surprise, preparation and or indeed failure to prepare. I think it was Sir John Harvey Jones, the ICI chairman, that said the great thing about not doing business planning is that when things don't go well, it comes as a complete surprise. And the same, of course, occurs when you're selling businesses. Number one preparation for us is what we call house doctoring. So we come up with this lovely image of the house and being in love with the house, but I do want to use that metaphor. So when you're selling a business, imagine you're selling a house. It needs to be tidy. You need to have done the survey beforehand. You know, are the contracts in order? What are the terms and conditions? And you need to depersonalize it. But you also need to go for curb appeal. So again, Sally and I are looking at a transaction at the moment for some clients. They are predominantly a SaaS business model, but when we were playing around with the website, a lot of their offering comes under a services title. And of course, we're looking at it going, well, actually, that's confusing. So the first thing that a buyer is going to see when they go to the website is they're not going to be clear on the business model. So presentation is important. And we're looking for that curb appeal and wow factor when we come into looking at a business. So clearly, things like websites go into that as part of the preparation in a pre-sale position. I'll talk about data and I'll talk about that positioning a bit more later. Ultimately, depersonalizing the business so it's not dependent on the owners is probably the number one aspect. We see too many businesses where the owners are still the lead player, and that is high risk for buyers and makes it very difficult for them to take over. Consequently, they'll downvalue it. Number two, and I think this is very, very important and growing as an area. So lots of people in the past, when you're looking at selling businesses, it's all about John or Janet in the golf course telling you they got the multiple of 10 from the international trade buyer, and that's the only deal you should go after. But actually, our experience increasingly is that is not the case. Over half of our transactions are private equity today. So you've got to look at all your exit options when you're selling an emerging mid-market business. So really, you know, not the SME end, so the SME is probably the sub 1 million, sub 2 million deal value, but the 2 million plus area really do need to look at all exit strategy options. Trade sale, MBO, private equity and employee ownership. And possibly, and we'll talk about this a bit more later, all of them in parallel as well, because you can run a situation where you see which are the best options as you go. I'll give you an example of that. We had one client had come to us looking at an MBO. We started to go down that route, a company called IRAT Roofing. But as we were looking at it, because of the financial restraints, personal guarantees required by the management buyout team, third-party funding, and our client's position where they didn't need all the money on day one, we actually structured an employee ownership sale, and the deal value was something like £2 million more than the MBO. And that's because an MBO would typically be over a 3-4 year period. The EOT was a 6-7 year period. But we also have people coming to us saying, look, I don't want to do private equity. I don't get it. I feel nervous about working with them. They all wear suits. And yet, when we go out to open market, we're looking for the trade sale. It becomes more and more apparent that the private equity is the better deal. Sally, and we'll talk through some of that later, because she's been specialising in that a bit for us as well. So number 2, don't assume that the trade top dollar international buyer is the only player in town. That is often a myth. Number 3, selecting the right advisors or selecting the wrong advisors. So it is a mistake to go with advisors that don't challenge you. Now, I'm aware we've got clients and advisors on the webinar today, so I think that, good advisors know this. Good advisors are not there to just agree with clients. They are there to advise clients. They're also there to challenge clients. And in particular, things are, we want to run an auction, we want to get top dollar, but also being realistic with clients about deal structure, types of exit strategies, and actually some of the downsides of the business, the strengths and weaknesses, and then preparing the business around that rather than telling people what they want to hear. So it is advisory, not sales. There are too many people in M&A and corporate finance that start at the sales end, finish at the sales end, and don't actually do the advisory bit. And I think it's really important to select the right advisor who's got experience of your sector, understands your business model, and will take the time to listen. That's important. If we've not got an understanding of what you're trying to achieve, we can't get there. Mistake number 4, we sort of related to presentation and preparation, sort of. COVID is probably the first massive arena where we've seen actually it's as much a war of data as it is the healthcare challenge. Data is central now to deals. If you can't prove in real time, anytime, your company metrics, you can't sell it. So that's real time, anytime. So you need the right KPIs, the right management information. We're increasingly reducing the focus on the CIM, the information memorandum, and we're focusing far more on the marketing data room. That creates a situation where buy side can make a decision from anywhere in the world, and it's not just appealing to the CEO, i.e. the sales story, the strategy story. It's appealing to the FD, the IT director, being able to present the empirical data so that buy side can reach a decision effectively. And that needs to also include forecasts. So I think this is a big area. Very often people have finance controllers, not finance directors. They're not on top of the financial information. They can't model it, so they can't demonstrate the sustainability of the business. And as a result of that, we end up being punched up in the deal room. And it's not pretty. We've got one at the moment where my colleague, we did a sweepstake on how many people were in the deal data room. There are 40 advisors in the deal data room. Now, that's gone mad. I think there's a little bit of jumping on the bandwagon there now. But nonetheless, it shows to get a decent sized deal across the line, the level of data and detail and advisors that are going to be looking at this, you've got to be robust and ready to cover it. Number 5, failing to check who your buyer is. you know, it's pretty obvious they're going to come in and check you in detail, in depth. They may give us a headline number that we like the sound of. Enthusiasm gets us carried away, and we forget to go into depth. What is their track record of doing deals? You know, let's talk to other people they've done deals with. Yeah, fine, they're telling us they've got the funding. Let's go talk to the funders. And also, what's their final decision-making process? You know, if it's private equity backed, if it's trade backed, if there's private equity, if there's finance, and there's also a board, you've got 3 decision-making processes to go through to get this across the line at the end. So you need to make sure that the buyer's in a position to do this and are also using the right advisors. Very, very problematic if you've got a transaction where you've got people who don't really know what they're doing on both sides of the fence. So we do need, however good that headline number offer is, to go back in and go, hang on a minute, how good is this truly? What's your track record buy side? This is the negotiation point. Number 6, mistake number 6. We all know that deals are about negotiation as much as they are presentation and the strength of your business. And, you know, we get very caught up in the technicalities and forget that often some of those technicalities are being used as an excuse to negotiate. And of course, the one that is so important is you need to win when you're negotiating the big points. If an advisor's running this for you, they will be focused on that. And you need to be prepared to lose on the small points. So this is what we call tradable. So it's having a really clear list of what for you are small points and what are the big points. So ultimately, what's the ambition, what's the headline price, and how do we get there? And therefore, which of the smaller areas are we prepared to concede on to keep that value in there and to hold that deal price up? You can't negotiate unless you've taken the time to understand the buy-side strategy. We'll talk more on that later, but it's a listening job. I also remind people with negotiation, it is entirely possible to negotiate with a smile and be incredibly firm. That is really important. So many people see negotiation as adversarial. It's not. Negotiation is about mutual cooperation. If you go in with that, you can quite happily say no, but you need to do so in a way that creates that goodwill and keeps that goodwill. So nice guys win, and definitely a mistake to treat the process as adversarial. Number 7, lack of clarity on a post-deal basis. I think this is important. The stats on M&A are that half fail to deliver value, mainly around, well, lack of strategy on a deal. We'll talk about that a bit more, but also lack of cultural understanding between the 2 businesses. Good example, Time Warner AOL deal, bunch of film guys, a bunch of media guys, got hyped up in the early 2000s. Probably the largest M&A transaction to go completely south in the world still to date, and ultimately they didn't talk the same language. And I think we get so caught up in the technicalities of the deal, the debt-free, cash-free, the normalized working capital, the earn-out protections, we forget that in the end this is going to be a partnership. Whether it's private equity or trade, how is the business going to operate after? Who are the lead players? What are the synergies? What's the economy? How are we going to go after the business plan? What's the joint vision? Another example I really liked was the eBay Skype deal. eBay bought Skype because they thought that by increasing the communication across their platform with their buyers and sellers, they would dramatically increase trade. Obviously, there was also the argument that by having Skype, revenues would increase in both businesses. Simply missed the fact that when you're dealing with strangers, people want to email, they don't want to pick the phone up. So a very expensive deal, and in the end, the strategy was wrong. So when you're doing a deal process, don't forget there's a business planning process. How are we going to merge? What are the forecasts? How are we going to run it? And what's the vision? Really important, that one. And we think people get a bit lost in the process. Mistake number 8, we've seen this from time to time. You've got a buyer, they come in, they tell you they're going to be the best game in town, they put a pretty good offer in front of you, it's highly attractive, you don't want the stress of going open market, you take the deal. Now, that's not to say that the sweetheart, the direct approach, is not the best deal in town, but there are many, many people out there chancing their arm on the sweetheart approach in order to get the best value. We had one fairly recently Sally was involved in, I think was in the healthcare sector, where the original sweetheart offer came in at 9.5 million. Our clients very wisely came to us. They talked to us and they talked to BDO actually. They appointed us because we understood their culture better, which was great. We took it to open market. We got 4 bids. The upfront deal value was 13 million. The rollover took it to about 18 million. So 9 million went to 18 million after the 2-year period when they achieved their deal. And it was still the sweetheart buyer that bought it, despite the other offers. They weren't best pleased with us, but they had to accept that was the game. So listen, if you've got a direct approach, if we think it's a blinding blowaway approach, we will tell you, but you've got to be aware of that power of the open market, the auction and the competitive process. Which brings me to number 9, BATNA. I'm really interested in this. So BATNA stands for Best Alternative to a Negotiated Deal. Now, Sally and I, probably going back in some of our 50 years, we used to call it the walkaway. But I think it's a bit more sophisticated than the walkaway. The problem you've got with a walkaway is it's often used as a last resort. And it's also pretty adversarial. It's very much about slamming the door on people. And I think that's a mistake. And so what we're seeing increasingly, and again, the use of data rooms enables this, it's genuinely about having alternatives when you go into a deal room. Yes, we're interested in trade because of the synergy. Yes, we're interested in private equity because we are interested in growing this business and keeping it and taking it to the next level. Yes, we're interested in the strategy. If the deal's not right, we may well keep the business. The value's only going to go up. And by the way, we may look at MBO or EOT again if a deal's not right. So there's genuinely a scenario where you could link that walkaway and alternatives to that earlier slide where I talk about having across the piece exit strategies in an equation. We've got some transactions now where we are going knowingly on an open market basis, but with employee ownership trust as a backup strategy, and people are pretty happy with that and keen with that. Obviously, you've got the question in terms of timing with all of these things. A good example of BATNA, and they stumbled on it by mistake, I'm afraid, but nevertheless, hugely profitable mistake. Netflix walked into Blockbusters in the early 2000s. They had major problems. And they basically were trying to persuade Blockbusters to let them run the online side of their business. Blockbusters CEO, when they asked for 50 million, did a little rise, sort of downward turn of the lips and a smile and a sparkle, and basically said, you know, 50 million, you're joking, and didn't go for it. Now, because of his attitude in it, the Netflix guys did walk away and go for the organic alternative strategy. Well, look at the story now. Where's Blockbusters? Where's Netflix? So, look, it's a bit by accident, but they genuinely had that alternative strategy of hanging on, and Blockbusters just didn't get it, even though they were the obvious buyer. So I want to come back to this, and number 10 is keeping it simple. There's a lot of jargon in M&A. There's a lot of fighting on technicalities, and I think that is advisory led, and I think that's because advisors forget, and it is easy, and buy side, sell side forget. In the end, there's 3 cores to M&A. What's the price you're paying? And of course, if you buy something, you paid too much, and if you sell something, you didn't get enough. That's an old trading adage. What's the logic behind the deal? What's the strategy? eBay Skype, flawed strategy. AOL Time Warner, flawed cultural strategy, film guys, IT guys. And of course, then that's the handover and integration process. What's the business plan after the deal? So if you've got 8-page long heads of terms full of jargon, I'm afraid it's not a good start. We need to strip it down to what are we trying to achieve and can we all understand it and what's the simplicity in that transaction? Because if you haven't got that, you're just going to layer cake complexity and the deal is more likely to fall over as you go wrong. There's a law of deals. The slower you start, the slower they are to finish. And the more likely you are to have what's known in the trade as a black swan event. So black swan event is a completely unforeseen event that absolutely blows everybody apart. Now, the point is with black swans, they're always unforeseen, but the unforeseen is always foreseeable. It's inevitable. The longer things go on and the bigger the project, the more likely something is to go wrong. So if you keep it simple at the start, you're more likely to do it quickly and the deal is more likely to hold. I think number 11, I'm in danger of today. So we're going to get into our next session, which is going to be in conversation. We're going to take some of your questions and we're going to chew the fat on some of the stuff we've talked about. We can, of course, do technicalities. As I say, I'm mindful we've gone big picture today, but I think that's useful for you. But rule number 11, talking too much. So this is a reminder of negotiation and selling techniques. Yes, you're enthusiastic about the business, but as an entrepreneur, salesman, normally most entrepreneurs are sales focused. You know, you can go into a room absolutely enthusiastic about the economies of scale, the synergy of a deal, the growth prospects of the two businesses combined, and all of that, and fail to ask the questions: what are buy side trying to achieve? What's their strategy? What's important to them? So this is the classic 2 ears, 1 mouth, and whether that's selling and or negotiation. I'll be honest, I talk too much. As an M&A advisor, probably one of my hardest areas to work on, and it's really, really important. So we also got talking too much in negotiation. If you say no, it's really interesting how many people forget to pause afterwards. And that's because no sounds a bit confrontational, so we fill the silence. But it's very possible to go, guys, thanks for that offer. For these reasons, it's not right for us. We're not doing that. Please let us know if you want to change your mind. We'd love to stay in touch. And shut up afterwards. It's as simple as that. But we fill the space. We feel uncomfortable doing it. And then we don't actually get the shift that we're looking for, particularly if it's a tactical no rather than a final no. You've got to be clear on that. So very much, what are they trying to achieve? Why are they looking at it? What's important to them? How can we play to that? And then we go into sales and negotiation mode and use those pauses to create power in the transaction. Okay, so 11 worst mistakes. I'm going to bring Sally in now, and we're going to do some chewing the fat on this. I'm just going to stop the screen share so you get a full view of us both. And we've also had some good questions in. Please ask questions as we go. Really appreciated and really useful for us all. Sally, I've talked a lot. Do you have a big takeaway on anything I've covered there? Is there anything you're going, you need to go into more depth on?
I think you could go into more depth on absolutely everything. I think it's probably worth looking at some of the questions of what people are interested in knowing more. I see on the chat, David Anderson's put a question in, which is slightly off topic, but probably worth addressing. Do you want me to take that?
Yeah, I haven't seen that yet, so that'd be good. Thank you.
Okay. Hi, David. Thanks for that. David's asked sort of why our consultancy services are open to businesses with 1 million plus turnover. At Avondale, we do have one level of service, and that is an A-level service, basically. And we find it's not cost effective for most companies on a sale mandate with a value of less than sort of £1 million. So that's just sort of we need to have some sort of capability of restricting the level we deal with. Does that help?
Yeah, I think that's good. And the skill set of emerging mid-market is very different to SME, isn't it? It's more technical. So
we do work closely with. We have now found a very good M&A provider who works at the smaller end that we will happily sort of pass details over to. And we're always happy to have a conversation with someone about it to see what the aspirations are.
So we've had a good question about timing on deals. I didn't really talk about that. So, I mean, clearly timing's difficult, right? And a mistake is if you get your timing wrong, you want to be selling near the top. Do you have a view on timing after all the years doing deals? Have you got?
Yeah, well, there's lots of factors that come into play. There's the right timing for the shareholders, there's the best timing for the business, and there's the best timing in the market. And those things are not always aligned. More often than not, it's the shareholder timing that drives it, which isn't necessarily the right way to do it if we've got time to prepare the business for sale. And that's why we encourage people to come to us years before they're thinking about this process, because if you leave it too late, you have no choice. In terms of, Kevin mentioned sort of the growth of the business, any buyers wanting to invest in a business that has growth capability and ideally is already showing that growth. Now, it may be that the growth isn't there yet, but there's been a new product, there's been a new client that's just been won, a new market that's been entered into. So there's lots of ways of showing the opportunity of a business, and it's about presenting that in the right way to buyers and making sure that's as secure as possible. Kevin mentioned SaaS businesses earlier. They go for very high multiples because of the contracted revenue. So the more time we have to prepare the business for sale, the better.
I think that's actually, I didn't mention that when I talked about the house doctrine. We've recently launched this vendor assist service, which is effectively the house survey before you go to market. And I can see people buying that more because sometimes COVID, for example, might impact on timing in terms of your performance. So that's relevant. But I think also there's a real synergy in that preparation to what you actually need when you're selling a business. And people often look at the timing and go, maybe it's arrogant, maybe we see what we want to see. My business is great, it's growing, that's good enough. And they forget that for buyers, it's not just about growth, it's also about risk and getting the detail right so that they tick their corporate governance. Do you have a view on that, Sally? Absolutely.
It's about market positioning as well. So growth has to be sustainable. There has to be a rationale behind the growth, and a buyer has to be able to see that they can continue to deliver it. That ties into lots of other points, including the point that you raised earlier about shareholders not being too integral to the business.
I think you know, and that links back also to the forecast, doesn't it? Because if the shareholders are too integral to the business, you can't achieve the forecast. If you haven't got the forecast, then you can't show the growth. But actually, people get quite granular. A great question I had the other day, which I don't think many people can ask, but you know, of your sales pitches, how many have you won and lost in the last 12 months? And I'm sitting there going, oh, I know we've got that stat somewhere, but it's not good enough to have it somewhere. I need to be able to pull it and show it to people, you know. So
I think that's the key, isn't it? I think most people can pull together things from somewhere, and that's what generally happens in the due diligence process. And by then, coming back to your point about starting simply but with speed and effectively, if it's taking us too long to pull everything together, it just slows the whole process down.
Okay, and another question's come in on the advisory front. I suppose you know, the viewpoint that your competitors are the best buyer, therefore why can't I kind of almost run my own process or go with the sweetheart deal? Do you have an opinion on what we see with that?
You might remember we did some research a few years ago now on how many companies we sold to the party that our client felt would be the right buyer when they first approached us. And I think it was around 3% from memory. I'd need to double check. And the reason for that is most people are understandably tunnel visioned in who they think that buyer will be, and they do tend to look at the direct competitors, and a competitor isn't necessarily going to offer best value because the business doesn't offer best value to them. It offers market share. So as part of our sort of research of likely buyer types, what we're always looking for is that synergistic buyer who's going to have cross-selling opportunities, who's going to be able to take the 1 + 1 to 3 or 4 or even more over time. And then those buyers can come from far and wide and aren't necessarily in the sort of the vision of you running a business. One of the other factors in terms of the process is not just about identifying a buyer. In some ways, that's the easy bit. The sale process is about negotiating and structuring a strong deal that's going to stand the test of time through the legal process, coming back to the point about good advisors all the way through. And that's what we're going to do for you. We're not just going to put together a good deal that's going to be effective for both parties. And do remember, there's only one deal. It has to work for both teams. Yes, that you have to work for one side, but at some point, everyone's got to come together on the same deal. And it's really important that we manage that process working with the legal advisors. There's a lot of commercial points that will still come up as part of the due diligence and legal process, and you don't want your lawyers batting those back and forward on their hourly rate. One springs to mind that happened many years ago, where we had 2 lawyers fighting unbeknownst to us for a good week about the length of the restricted covenants, that being sort of how long the exiting shareholders had to stay out of the industry. Well, by the time we got involved, they spent quite a few £1,000s on behalf of both sets of clients. And I just had to remind them that the exiting shareholders were in their late 70s and would happily have signed up to a restricted covenant of 20 years. So it's just taking a sensible approach to these things.
Okay, but I mean, you know, lawyers can really add value to a deal, though, can't they, in terms of the balancing the risk between the two parties? But I think you know, I mean, not being critical of lawyers, it's the nature of lawyers. They sometimes can forget the commerciality behind it, but the really good ones will step back and at that point and allow buy side and sell side to drive the commercials.
Absolutely. There's a lawyer I work with quite a lot, and he often says to me, he says, "That's great, Sally, thanks. I really need you to remind me about the commercial reality of it. And that, yes, legally, we'd like to have this position, but if we look at what's likely to happen in the real world, yes, that is a risk, but the risk is not proportional to what we're doing."
But I mean, looking at this as advisors, of course, we're the right advisors. We want come to us, we'll look after it all. But the wrong lawyer is a problem sometimes, isn't it? Let's be blunt.
The wrong lawyer at both ends of the scale can be a problem. So the wrong lawyer, I haven't seen it more recently, but sort of Kevin's alluded to the number of years I might have been doing this, but many years ago, someone just went and used the person who'd done their conveyancing on their house the prior year. Absolutely disastrous. But the other end of the scale, having a top lawyer, one of the big London firms, can be a mistake for the wrong deal. Nothing against those lawyers, but if you've got a sort of more maybe sort of local lawyer who's not up to that level on the other side, it's just going to be mismatched, and it's going to be very difficult.
Actually, Sally, you're right. You're too young for 20 years experience. It's fine.
I wasn't going to share the numbers.
So, another question's coming. Do you find PE more likely as a tactic to offer high and look to chip? So private equity, finance guys, Excel spreadsheets, they love it. Are they a bit sneaky on deal? You know, they're more sneaky than trade?
No, I think PE have a bad reputation, and I think that's wrong. Going back donkey's years, yes, one could argue that they sort of came in, brought far too much reporting into a business and hampered growth that way by not adding value. But I just don't see that anymore. I just had a deal chip coming back to the sweetheart approach yesterday, and the buyer holds all the cards. They know they are the only buyer at the table. and they've just 2 months into due diligence, a couple of weeks before ready to complete, knocked the deal for nothing that's come out of due diligence. I have not seen that with any private equity in the deals I've done for 5, 6, 7 years.
We're not that tactical. I do think private equity is really interesting because I know government is starting to look at it with people like Morrison's being looked at in US private equity. You know, it's 2.3 trillion in Europe looking for a yield. Emerging mid-market businesses is where the action is because that's where the value is and the scale up is. So I'm really hoping government don't over-regulate it. You know, there's nothing wrong with financial owners scaling businesses up. It adds value and it adds value to the economy. So, you know, we're pretty keen. I think the other thing it does is it stops, and it's not for everybody, but some owners where they're going, well, where do I put my money after I've sold the business? I've already made some money. You know, by holding an investment in your own business, that's a pretty good, if we can double or triple the money, typically that's what they're looking to do. That's a pretty good investment.
Absolutely.
You've done quite a lot. Yeah, because you've done quite a lot of private equity. For most of your owners, they've not stayed MD; they become chairman. Is that right, or chairperson, or have they stayed MD?
Huge variance. So earlier this year, it's actually a mum and son. Mum started the business, son had been brought in through the process. Again, testament to the private equity buyer. They'd really taken him along in terms of helping prepare the budgets and the forecasts, and he'd learned so much. And by the time the deal was struck, mum stepped back and son's there running the business. I've got another that was, I think, last summer, whereas it was 3 owners, all very young, all in their late 20s, early 30s, but the business was just growing beyond what they could manage. And it was a trade-back private equity, but still they're very much, they rolled over into Group Co, and they've stayed with the business, and the intention is they will stay with it probably longer than the owners of the trade company, given the age profiles, and they're looking to potentially float in the future. So there's a wide mixture. I've got one at the moment. It's probably we're waiting on an offer. This is retirement. We've talked about shareholders not being too integral to the business. In this case, they are. There's no doubt about it. But there are still buyers out there who will quite happily go on that transitional journey, finding the right replacement for those shareholders, be that promoting and training from within or recruiting from outside. And there'll be an 18-month transition, and then they'll step back completely. So there is a huge variety of options out there.
I think the other thing we you know, I mean, the trade do more often than not, even with an earn-out, you're out within 2 years, aren't you? So
yes, or sooner. Kevin, I'm just aware there's quite a lot of questions popping through. Shall we?
Okay, yeah, you can run those. Yeah.
Go through those. I'll have a look at the quick ones on the chat first. Do it represent buyers also? Yes, absolutely. We've done quite a lot of acquisition work. It works alongside sort of the strategy department more in terms of ensuring that that acquisition is the right strategy for the business. Kevin could probably talk to you about one sort of very big international purchase that we worked with that I think from memory I answered the phone to. They sort of wanted to buy a particular type of company, and by the time Kevin and the strategy team had spent some time with them, actually they didn't want to buy that sort of company. They successfully made a few other acquisitions.
Yeah, which has been very successful, yeah, because they hadn't looked quite far enough ahead. The sector, yeah. Yes.
Next sort of one coming through on the chat is percentage of deals, does the price or terms change during due diligence? I just mentioned one. I advised my client not to go with these buyers in the first place, but for personal reasons, he just wanted to get a deal done. I've had one other that was COVID related, but apart from that, I can't think of any. We spend the time at heads of terms and before that, making sure that every pitfall is addressed and solutions found, so nothing comes out of due diligence to create a problem or surprise a buyer. We'd rather put something forward up front that we think might be a problem and deal with it than try and sort of step away from it. Of course, if something changes during the due diligence process, which can happen, as the last 16 months have proven to everyone, then yeah, there might be a situation that we need to look at the deal. But as I said, 2 examples I can think of in the last 10 years.
That is about attention to detail in the marketing data room, isn't it? If you've only got an IM, it's not enough, because they can then come back because they've only had the sales information rather than the more detailed information. So that's an important, I think, change to the way that you can run projects.
But also having a competitive environment. I've a deal that we've got heads of terms at the moment. It was very much predicated on the projections for 2021 year end. Well, for various reasons, they're not going to be met by a significant amount, by 100,000. And we've managed to work with the buyer to keep the same deal in place with a few tweaks. And I'm really delighted with that for the sellers. But it's also a good deal for the buyer, because the projects that are being lost now, they're going to come online later in the year, so that they'll make it up. But again, that's about the relationship. It's about the culture between all parties, and coming back to the point that we run it as there is one deal. It's not adversarial. It's not combative. So we've got a good relationship, and we're able to work through these issues.
We've got that question in from, I think, James here. This question relates to a few of the points, but could you elaborate on the importance of not getting too invested emotionally, letting the ego take over? None of our clients are ego driven, and how crucial objectivity and the externalization is to a deal and process in general. So I think that question is on ego and staying objective through the process, I think.
Assuming that's the point of the shareholders not getting too invested emotionally, as opposed to us getting invested emotionally.
Well, it could be both. So yes. What's it known as going native, when the advisor forgets. The advisor is so vested in the deal that they can't pull away either, or be objective. Yeah, that does happen.
And I think also we work very closely with our clients, particularly on, well, with all of our clients, but particularly on the sell side. And I do sometimes think of us, and you can forget that it's not your deal. But the point is, it's not about ego. None of this is about any of us as individuals. It is about investment. And now that may be a pure financial investment. It may be an investment from a trade buyer to enter into a different area of the market, but it is a business deal at the end of the day. And it's just, you have to step away from that ego. Kevin mentioned the golf club conversation. I don't know. I'm not a party to all those conversations. My cynical brain would say that 90% of them are elaborated in some way, shape or form. We hear all the time about deals and multiples, and if you get under the skin of it, you can justify any multiple by the time you've chucked the freehold into the equation, and the fact that there's £2 million of free cash sitting in the bank. You just need to go through the process, being realistic and pragmatic all the way through, listening to advice, but listening to your gut as well, and having alternatives, and remembering that this isn't the be all and end all.
Yeah, it's about the journey, isn't it? I think, but do you think clients can forget that? They can forget how they started. You know, I mean, we've had it before. We've had clients when we started going, oh, well, I'd be happy with 3 or 4 million, and we've been working with them at 5.5 million because the business has grown a bit. And at that point, it's still not enough, because they get caught in the headline number and forget how they started. Would that be fair?
Absolutely. And you have to work with your clients in that situation to come back to, why are you selling in the first place? If this is purely an investment decision for you as well, and it's an investment decision for a buyer, you're probably never going to reach a deal that works. There has to be a personal motivation, which is typically on the seller's side, and that's quite often important to remind them of that. Now, there are definitely cases, and I've got one at the moment, where the business has grown. I think we were calculated yesterday, GP's gone up 67% from year end 2020 to year end 2021.
Wow. Okay.
Obviously, value expectations have gone up through that process. But we're now trying to work hard to work out, okay, at what point do we have to draw a line in it and say, yes, we are handing the buyer a business that's going to grow potentially exponentially. you have to smile and wish them well with it and be happy with what you've got, because that's what's enough for you and what allows your next stage in the future.
Well, it's that trading adage. If you sell something you've never sold for enough, of course, but
Yeah.
you know, you're allowing the curve for that growth, for the upside for the buyer. And then there's that whole, it's a hippie question. When is enough in life? But James, to answer your question, it is ego driven. It's all about me, right? That's the way entrepreneurs think. And I think in the end, they do have to try and put that aside. It's very difficult. I make the comment from a leadership point of view as well. We live in a world where teams, collaborative teams, are more smart than individuals. And that's absolutely proven across all areas of business. So if you are ego driven and it all has to be your idea, it's going to be a problem. I think Sir Fred Goodwin, the RBS deal, that was driven by his ego. His board didn't have the guts to turn around and say no. They tried to, but they couldn't stand up to his personality. Well, that nearly led to the credit crunch on its own. So his purchase of ABN AMRO. So you've got to be really careful of egos when it comes to M&A. Cool. We've had a question here on our sweet spot on deal size, Sally. What's your answer on that?
I think the biggest deal we've done, Kevin, you might need to correct me on this, but I think it's around 50 million on the sell side.
Yeah.
But our sweet spot, I would say, is probably 3 to 10, maybe 5 to 10.
Yeah, so that's where we have the most, but the range is 2 to 40, isn't it? And you know, we've got, you know, more in the sweet spot, but quite a few across the range, I think. Yeah. I mean, I think you sort of come back to, I like to think of it more as profit. It's 500k to 5 million EBITDA. And the reason for that is I think the big boys, you know, your Grant Thorntons and what have you, like doing the stuff above that. And the buyers are more obvious, international buyers. I mean, and come back to our black book of private equity, I think we've got a really good position where we've got very strong emerging mid-market private equity specialists. But again, you've got your more corporate private equity above that 50 million area. And once you go above 50 million, IPOs and things like that come back in vogue. I do think IPOs are interesting at the moment. It's not something we do. We're looking at how we can partner with people more on that. I do think there's going to be an increasing number of IPOs, simply again because of this lack of organic growth that driven by, well, we had the credit crunch, 2008-9, now we've got COVID, we've had two massive crises. The only way out has been to print money. So we can't even go down the inflation route to reduce that debt. So we're going to have to raise taxes. That's going to slow economies. In really slow growth economies, money in the bank then actually costs money. So where do you get a yield? And M&A is central to that. So I think there's going to be a lot more action in the buy and build area, putting companies together, 10 million plus 10 million, grow it, economies of scale, synergy, and then float, for example. And I think there's going to be an awful lot of activity as people look at that area. So, yeah, I mean, I think we sort of answered the sweet spot. I'm talking more generally about what we see coming up in the market. And there are arguments more generally in the market that multiples could go up because there are fewer quality assets coming to market. Do you have an opinion on that yet, Sally?
We thought that last year and speculated around that last year. We certainly were delighted with the deals that we completed last year. Everything come March, April, sort of ground to a halt, fell over, and we've managed to go back and pick those up, some of them at a higher multiple and at a higher value. I think multiples are definitely creeping up. I wouldn't say that they're significantly higher yet, but I think it's too early. I think we need to get past the sort of the pandemic, the COVID period, and into next year. But what we're certainly seeing is really, really significant levels of interest, both from trade and private equity. and from people wanting to do deals. I don't think we're going to see as time goes on, but businesses, or all businesses, have been as badly affected as maybe the media plays out. A lot of our clients have been very successful during this period. There's been a lot of startup businesses. I was doing some research yesterday for a client into the fitness industry, and there's been investment into startup gyms during this period, which you wouldn't necessarily think was logical. But investors see beyond. Investment is a long-term play, and they see beyond the next 6 months, year, into the future. And that's where the clever money goes, and it may well drive multiples up, but I think we'll have to wait and see.
Yeah, I mean, I'm really enthusiastic for UK PLC. I think, you know, we are a business services sector-led business. I'm not saying we shouldn't be doing more manufacture, but I think, you know, there will be more onshoring because of COVID. But ultimately, our business service focus is what drives the economy. That is global. And actually, COVID, and if our own experiences anything go by, accelerates those businesses in terms of their productivity, because, you know, you've got the whole hybrid working, the virtual working, and I think that increases the ability to do M&A cross territory. So once we come out of the pandemic, you're going to get a lot of activity. So I think the drag will be tax, which may be another reason why people should be looking hard at selling businesses now. We do think tax is going to go up. Any views on tax, Sally?
Had nothing but views on tax for the last 2 years, really. It's pure speculation.
Yes.
Yeah. Look, there was a paper, for those who don't know, that was sort of commissioned looking into sort of capital gains tax and bringing it more in line with income tax rates. And the suggestion was that's what should happen. Now, whether it will or not, my gut instinct is it will. Whether it's going to affect entrepreneurs relief or whether it's going to affect the standard level of CGT, we just don't know. We also don't know when it's going to happen. There's a lot of speculation in the budget this year. There's a lot of speculation in the budget last year. We're now all sitting on our hands with every deal we're working on going, right, we've got to get it done by September, October, because the budget will probably be November. We just don't know. There's the saying, isn't there, don't let the tax tail wag the deal dog, but it's very hard to do when you're potentially looking at a difference in 20% versus 40% capital gains.
I'm more optimistic than Sally. I'm pegging it 28% because that's what it is in Europe. And I think if you go at 40%, then because you can work anywhere, all you do is drive the money offshore. The Treasury have been there before. I don't think they're that daft. But as Sally says, who knows? There is only one way it can go, which is up. There's no question of that, because with the inflation, we can't inflate our way out of that debt. We've got to repay it. So the only way to do it is increase taxes. And the triple lock stops them doing it on income tax. So, you know, it's going to be things like CGT they're going to come at. So it's definitely under the radar, isn't it? So on the radar. Sally, mindful of time, we've got 3 or 4 minutes left, but I'm also mindful of that huge experience that you've got as a deal maker. I've done my 11 worst mistakes. For you, what is the sort of worst cock-up you've seen on a deal?
I'll do one specific one. I'll do my generalist and I'll explain the specific one. The worst ones generally come from using poor solicitors. We obviously don't get involved in the ones using poor other advisors. But yes, if you have poor solicitors on buy or sell side, it is disastrous. I had a client once where I recommended the lawyer to both buy side and sell side. And my client turned around and said to me, oh, make sure they get a rubbish lawyer or make sure mine's better than them. And I had to explain, it doesn't work like that. You need strong corporate lawyers on both sides who are going to be commercial and understand the process and understand that you need to have tradables. You cannot win every point. By the very nature of it, what is good for a buyer is not good for a seller and vice versa. So you have to know which are the points you need to win, and you have to know when to walk away, but you also have to know when you can concede a point. Now, you might make it a tradable, you don't just concede a point, but the point being that you don't just fight for the sake of it. And I've seen lawyers do that. And I've seen lawyers take deals down because of their egos. The gentleman asked about egos before.
I'm thinking we should have invited a lawyer on today now, because then they could defend themselves more. But yeah, sorry, but yeah.
Well, there are lots of very, very good lawyers,
Yeah.
but like any industry, there's good and there's bad. The other point is not letting, and this may seem contrary to what we've said about being collaborative, but not letting the buyers and the sellers have too much direct contact through the process. And this isn't because we don't trust buyers or sellers. There's two reasons. One, the deal hasn't happened yet. And I've seen it too often where buyers and sellers get carried away and start being collaborative in terms of trading. And then it's something they then have to unpick if it doesn't work. But more to the point is, we are here for a reason. Your advisors are there for a reason, be it us or the lawyers. And it's because we know what problems can come up. We know what pitfalls there are likely to be. And buyers and sellers naturally will become chummy, they'll become friendly, because you wouldn't enter into this unless you had felt you had a rapport with them as individuals. And before you know it, you've agreed to something that you didn't understand. And we've seen it before, complex, the working capital, the debt-free, cash-free, intra-month positions. And the buyers sat there and tried to explain something, and the sellers nodded and just agreed with it. Sometimes not wanting to look foolish, not wanting to look like they don't understand. And that's very difficult to unpick. The other reason being, and this is a story from many years ago, where I think it was the day before completion, buyer and seller were dealing directly with each other on a number of things because they wished to. One of them had sent an email to the other with a long email trail behind it, hadn't read what was on the email trail, and lo and behold, embedded in there somewhere was a not very nice comment from one about the other. Now, in the greater scheme of things, coming back to the ego point, it wasn't meant for that person's eyes. We all say things, don't we, if we're honest, that we wouldn't want someone else to hear. But in this time, the seller saw it, the buyer had said it, and that was it. He was out, pulled out, day before completion. And that was purely ego driven. It wasn't even that rude. I can't even remember what it was. But that's why we try and sort of, we recognise that. We know to delete the email trails before we forward things on, or at least read them.
That's not, we've all done that somewhere in the trail, haven't we, at some point? So, yeah,
absolutely, but it's that 50 years of experience of learning from it, isn't it?
Yeah. And then you go home that night and you go, oh, yeah, okay, so that's fine, yeah, okay. I mean, the other one on actually email, which is a story I remember, was when buyers bought it, then they controlled the IT, they then went through the emails from the sellers off their IT, off the server, to look for what warranty claims to make. Now, brilliantly clever,
yeah.
But schoolboy error number one, running the whole thing on the company's server. It needs to be confidential and off the server. Yeah. That's happened. You know, so you live and learn, don't you, with this stuff? Look, we've had, I think, a good session this morning, Sally. Sally's really approachable. We're going to, with the follow-up, we'll put our email out as well as mine. We'd love to continue the conversation. We're really happy to answer any questions. We're very open house, so if you've got questions on value or you know, preparation, we can give you an initial opinion. It doesn't cost anything. We like to get involved early, and we're always happy to share ideas, and hopefully some inspiration. I know today has been a negative webinar, i.e. the 11 worst mistakes, but actually, you know, sometimes the pitfalls can be more costly than the elements you get right. So the way I'd like to see the mistakes is, imagine that we're doing the 100-meter hurdles. They're simply hurdles. If you can see them coming up, you can flow over them and still get an excellent, good time. But you've got to know they're there, and you've got to work past them and see how to get over them. So I hope today's been useful. Please email, share ideas and insights. We have got some other webinars coming up, but we'll share that with the follow-up pack. Thank you all for listening, and have a great day all. Really appreciated.
Thank you, everyone.